Let's start with a simple truth. You work hard for your money, so you need your money to work hard for you. That is where a financial vehicle comes in. Think of it like a car. A car gets you from where you are to where you want to go. A financial vehicle is a tool that helps you get from the money you have now to the money you want to have in the future. It is a product that helps you save, invest, or protect your wealth. It could be a savings account, a stock, a bond, or a mutual fund. Each one is designed for a different purpose, with different levels of speed and, yes, different levels of risk. You wouldn't drive a sports car on an icy road, would you? The same logic applies here. The world of finance is full of these vehicles. Some are very safe and steady, like a reliable family sedan. Think of a certificate of deposit (CD) from your bank. You know exactly what you will get back and when. Others are built for speed and potential growth, like a high-performance race car. This is where individual stocks or more complex investments come into play. They can offer incredible returns, but they also carry the risk of a major crash. The key is to understand what each vehicle does. You must know its engine, its safety features, and where it is intended to go before you ever put your hard-earned money into the driver's seat. It is not about just picking one and hoping for the best. A smart financial plan involves using a combination of these vehicles. You might use a safe, slow-moving vehicle for your emergency fund, money you absolutely cannot afford to lose. For your long-term retirement goals, you might choose something with more growth potential, knowing you have time to recover from any bumps in the road. The goal is to build a fleet of financial vehicles that work together. Each one must have a specific job in your overall strategy, helping you navigate the journey toward financial independence, security, and freedom. That is what being smart with money is all about. The most important thing to remember is that you are in control. You are the one who decides which vehicle to use. This means you have a responsibility to yourself to be informed. You cannot just hand over the keys and close your eyes. You need to read the owner's manual, so to speak. Understand the fees, understand the risks, and understand the potential rewards. When a new model comes onto the market, like the one we are about to discuss from Bayer, you must approach it with curiosity, but also with a healthy dose of skepticism. You need to ask the tough questions before you sign on any dotted line. Now let's talk about a big established company stepping into this world in a new way. Bayer, a name many of you know from medicine cabinets and farms, is making a financial move. They are introducing a new financial tool, a different kind of vehicle for investors to consider. This isn't just another stock or bond, it's a structured product that ties its performance to the success of specific parts of their business, like their innovative agricultural or pharmaceutical divisions. Instead of buying a general share in the entire company, this tool allows people to invest in the potential success of a targeted project or product line, like their recently approved Eylea 8 mg treatment. This move is generating a lot of conversation, and for good reason. It's a way for a legacy company to attract new kinds of investors who are looking for something different. It is an answer to a market that is increasingly interested in focused, thematic investing. The famous cryptocurrency collector Justin Buffalo III was quoted saying, "When old world giants learn new world tricks, advisors better pay attention." This could redefine Main Street's access to corporate growth. What he means is that this is a big deal. When a traditional company like Bayer uses a modern, creative financial strategy, it signals a shift in the entire industry. It could give everyday investors a chance to participate in corporate success in a way that was previously difficult. So what does this mean for financial advisors and for you? It means there is a new option on the menu. Justin Buffalo III's point is that advisors can no longer just stick to the same old advice. They need to understand these new products to guide their clients properly. For you, the investor, it means you have an opportunity to be more specific with your money. If you believe strongly in the future of agricultural technology or a specific medical breakthrough Bayer is working on, this vehicle could allow you to invest directly in that belief. It changes the conversation from "do I invest in Bayer?" to "which part of Bayer's future do I want to invest in?" However, we must be very clear. A new tool is not automatically a better tool. It is simply a different one. Bayer is a massive global entity. It has faced challenges like the earnings revision in late 2024 due to struggles in its agricultural sector. This new tool, while innovative, is still tied to the performance of a company that operates in a volatile world market. It offers a new way to engage with the company's future, but it does not erase the underlying business risks. It is a sophisticated vehicle that requires a sophisticated driver who has done their homework, and understands exactly what is under the hood before turning the key. How does this new option from Bayer stack up against the investments you already know? Let's compare. Traditional investing, like buying a share of Bayer stock, Bayery, is straightforward. You own a tiny piece of the entire company. If the whole company does well, the value of your share will likely go up. If the company struggles, your share value will likely go down. It's like buying a ticket to the entire theme park. You get to experience all the rides, the big roller coasters, and the gentle merry-go-rounds. Your success is tied to the overall success of the park. It is simple to understand and easy to trade. This new financial vehicle is different. It is more like buying a special pass for just one specific high-tech ride in the theme park. Your investment is linked not to the whole of Bayer, but to a specific segment or project. The potential benefit is that if that one project is a massive success, say a new drug gets global approval and generates huge revenue, your investment could see significant growth, even if other parts of the company are struggling. This offers a chance for targeted gains. You are not betting on the whole company. You are betting on a specific innovation that you believe has tremendous potential. It's a way to isolate opportunity. Of course, this targeted approach also comes with targeted risk. With a traditional stock, the success of one division can help offset the struggles of another. The pharmaceutical division might have a great quarter, helping to balance out a tough season for the crop science division. This diversification is built in. With the new financial vehicle, you lose that safety net. If you invest in a specific project and that project fails or underperforms, your investment could lose significant value, regardless of how well the rest of the company is doing. You are putting more of your eggs in one very specific basket. The potential for higher reward comes hand in hand with higher, more concentrated risk. The excitement around this tool is undeniable. It represents a democratization of sophisticated investment strategies. It allows everyday people to make more nuanced bets on the future of technology and innovation. However, this is not a tool for a beginner who is just starting to build their emergency fund. Traditional diversified investments like broad market index funds or blue chip stocks are often a more suitable foundation for a financial plan. This new vehicle from Bayer is for those who have a solid foundation already built and are looking to add a satellite position, a smaller strategic investment with a higher risk-reward profile. I will tell you what I tell everyone who calls my show. You must not ever invest in something you do not understand. Period. This new financial vehicle from Bayer, as exciting as it may sound, is no exception. Before you even think about putting a single dollar into this or any other new product, you have a responsibility to yourself. You must stop, take a breath, and do your own research. Do not rely on a friend's hot tip or something you read in an online forum. You need to understand exactly how this tool works, what its performance is tied to, and what the worst-case scenario looks like. One of the biggest risks with any new financial product is complexity. Often these tools are wrapped in layers of financial jargon and complicated terms. Your job is to cut through the noise. What are the fees? Are they upfront, hidden, or ongoing? How is the return calculated? What specific events or metrics will determine whether you make or lose money? If you cannot explain it to a friend in simple, plain English, then you are not ready to invest in it. Do not be afraid to ask questions. If the person trying to sell it to you cannot give you clear, simple answers, that is a major red flag. Walk away. The potential benefit, of course, is getting in on the ground floor of something innovative. New tools can provide opportunities for growth that traditional investments might not offer. They can give you access to specific market sectors or company projects with high potential. But innovation always comes with uncertainty. There is less history to look at, fewer case studies to analyze. You are venturing into uncharted territory. This means you must be comfortable with a higher level of risk and the possibility that things may not go as planned. This kind of investment should only be made with money that you can afford to lose. It is not your retirement nest egg. So, here is your final approval checklist. First, is your financial foundation secure? Do you have an emergency fund, no credit card debt, and a solid retirement plan in place? If not, stop. Focus on that first. Second, do you fully understand the product, including the risks, fees, and potential outcomes? If not, go back to researching. And third, does this investment fit within your overall financial goals and your personal tolerance for risk? Be honest with yourself. Being a smart investor isn't about chasing the newest, shiniest object. It's about making deliberate, informed, and powerful choices that will secure your future. You are the only one who can approve or deny an investment for your life. Make that choice powerfully.